Now, while the UK and other global economies are already in a recession, we are now getting signs that the United States itself is entering a major recession that could hit next year. Hi guys, it's Stock Curry. We finally got some good short-term economic news, but we also have some indications that we might be headed for a major recession next year. In today's video, I'll explain how the stock market is going to react to all of this, so let's get into it! GDP is now set to turn positive once again due to shrinking US trade deficit and an end to the technical recession that we're currently in. A recession is defined as 2 quarters in a row of negative GDP. Here in the United States, both our Q1 and Q2 GDPs were negative. So for the past 2 quarters, we've had negative GDP, and that officially defines a recession. But because the US trade deficit is now turning around and lowering, that could be enough to cause Q3 GDP to turn positive once again. And if Q3 GDP is positive, then that will end our technical recession. The earliest we will be able to enter another recession technically would be Q1 of 2023, and that would require negative GDP in Q4 of this year and negative GDP in Q1 of next year in order to give us 2 quarters in a row of negative GDP once again. So this is really good news that we are coming out of this technical recession. Now, so far, the stock market really hasn't cared. In fact, when we officially entered that technical recession about 3 months ago, the stock market rallied 20%. So the stock market really doesn't care about this too much, but it is good news for the economy. We also saw businesses add 208,000 jobs in September, which was better than expected. Now, this was based upon the ADP private payrolls report, which is not the same as the official labor data. Still, this was really good news, and it shows that the economy remains quite strong. You may have heard about fears of a major global recession starting next year, and later in the video I'm going to show you some data that backs up why a lot of people think that we might end up in a major global recession starting next year. Those fears were causing a lot of people to think that the Fed might pivot and start lowering the rate at which they raise interest rates in order to fight inflation. A lot of that was also due to concerns that the US economy might be entering into a major recession here very shortly. However, after the good economic news we just got, San Francisco Fed President Mary Daly said that more rate hikes were needed, and she dismisses this talk of the Fed pivoting and no longer raising rates. If the Federal Reserve does in fact continue to raise interest rates at the rate that they are expected to, this will put a lot more downward pressure on the stock market. One of the reasons we saw the stock market rally so much on Monday and Tuesday outside of the technicals was just the fact that there was a lot of talk and speculation that the Federal Reserve might actually not go through with the higher rate hikes that they're currently forecast to do. So the market is absolutely not predicting that the Fed is going to stay hawkish and actually do what they said they're going to do. The market is pricing in the Fed giving up and becoming dovish once again. Unfortunately, there are some signs that inflation is starting to ramp up once again, and this is going to force the Fed to go through with their higher rate cuts. OPEC Plus just met today, and they decided to cut oil production by 2 million barrels per day in order to raise the price of oil. This is going to have the effect of raising energy prices across the board, which is going to kickstart inflation once again. In addition, the United States is not harvesting as many fish as it once did, which is also driving up the cost of imports. This is going to have the effect of pushing inflation up on food prices, and food prices have already been going up, but there are now signs that those food prices might rise significantly more. And of course, higher inflation does not just affect the United States, especially when it comes to food and oil prices. higher inflation affects the entire global economy and can trigger a global recession. Inflation and consumer pessimism have pushed 25% of UK businesses to close their doors. In the UK, a wave of business closures is now washing over the country, trapped between surging costs on one hand and weakening consumer demand on the other hand. Over 250,000 UK companies went out of business in the first half of this year. It was the largest number ever recorded in a 6-month period, and while data on business closures in the July to September quarter aren't released until later this month, many analysts expect the failure rate to have accelerated. Those businesses still operating face the prospect of even weaker consumer demand as the Bank of England raises interest rates to combat inflation. The Bank of England is very similar to the Federal Reserve here in the United States. It's the country's central bank, and they are in charge of bringing inflation down, and the reason they do that is the exact same way the Federal Reserve does. They raise interest rates and they cause an economic slowdown, sometimes to the point of recession. The World Trade Organization sees a sharp slowdown in global trade, pointing to a possible global recession. High inflation, rising interest rates, and global supply disruptions are weakening global demand for exports and imports. This is important to understand because the US trade deficit did not go down last month because the US economy got stronger. Rather, the US trade deficit went down last month because other economies got weaker at a faster rate than the US did. Our exports actually declined last month. The difference is our imports declined at a faster rate than our exports declined at, and that is why the trade deficit shrank. Now, while the UK and other global economies are already in a recession, we are now getting signs that the United States itself is entering a major recession that could hit next year. Mortgage rates just hit 6.75%. That's the highest since 2006, and it is triggering a major slowdown in the housing market, very similar to the slowdown we saw in 2008. And even though businesses added more jobs than expected last month, there are signs that the job market is slowing down at a very rapid pace, and that could lead to a major recession. Amazon is now freezing hiring in their retail division, and job openings in August plunged by more than 1.1 million. That was a 10% drop from the month before. And over 50% of CEOs say they're considering cutting jobs over the next 6 months. This is because 91% of CEOs in the United States believe a recession will arrive in the coming 12 months. This is going to lead to a self-fulfilling prophecy, where 91% of CEOs expect a recession to occur sometime before the end of next year. As a result, they're considering layoffs in order to prepare for that recession, and those layoffs in turn will actually trigger the recession. So this is not looking good for the United States. The Federal Reserve has already said that they want to get the number of jobs down in order to help fight inflation. The Federal Reserve is committed to causing a recession, and now the CEOs appear to be helping to trigger that recession, although it does not look like that major recession will occur until sometime in 2023. So what does all of this mean for the stock market? How will the stock market respond? Well, in the short term, because we do have some short-term good economic data, it does look like the market will bottom out in October and start rallying in November and December. However, there is also cause for concern that we might get a similar situation like we got in 2008, where the stock market rallied in November and December, but then late December into January 2009, the stock market sold off. And it's looking like even if we do get that rally in November and December, we will not get back to all-time highs, but rather sometime in 2023, we will start entering a major recession and we will see the stock market go down significantly. There are many economists who are predicting the stock market could go down another 40% from here. Follow me so you can understand all of the market news that's coming out. And if you got a lot out of this video, make sure to hit the like button and subscribe, and be a good friend and share this video with your friends and family so that they can understand what's going on in the market as well. And if you want to understand what led up to all of the market news that came out today, make sure you watch my last video that I uploaded here.